Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist with OptionsPlay. And today we're going to do a presentation on the basics of option pricing. So we're going to start out with what an option contract is and go through the vernacular of the options marketplace. And we're going to build out the strategy, and we're going to talk about the differences between puts and calls, about rights and obligations. The entire event's going to take about 45 minutes, but by the time we're done, you're going to have a very sound understanding about the fundamentals of how an option is priced. So, without further ado, let's get started. Important disclaimer, all the data that we're going to use today is not meant to be a recommendation, and past performance is not an indication of future results. If you're going to trade options, you should read the options disclosure document, which can be provided by the exchange or your brokers. All right, so here's our agenda. We're going to go through the anatomy of an option contract. Basically, we're going to build an option contract and talk about why the fact it's called a contract. Talk about the two different types, the two flavors of options, calls and puts. Talk about the options premium, or otherwise known as the options price. But I'll talk a little bit about why we have it titled as the options premium. And then intrinsic and extrinsic value, that's very important in the options trading world. We'll define those terms and get into how you figure them out. And then we'll just go through a couple examples. And if you have any questions, if you do put them in the chat box, we can try to address them. If you're on the Zoom platform, you can actually click on the Q&A box, and you would be able to put the questions in via the Q&A box. All right, now, very important here, if you want to get your phone up and you click, scan this QR code, there is a free trial that is available to you, and also you can just type it in, optionsplay.com/signup. It's a free trial for all the software that I'm going to be demoing today inside the Options Play platform. No obligation whatsoever, but we do want to make sure that the recording is going to be available for this, and ultimately so will the slides, and you can get it all through this QR code. Okay, so what is an option? Now, I've been teaching options for over 30 plus years. I wrote a little book called The Options Playbook, and I own the website called OptionsPlaybook.com. Now, the biggest thing that I see from beginning investors that come to a basic seminar about option pricing is that they have the wrong mindset. So my first question to you is, were options first created as a means to speculate on price movement, or were they first created to protect an underlying asset? I'll let you think about that for a second. Were they created for protection, or were they created for speculation? And the answer is that they came from a need to protect an underlying asset. Basically the value of it. Options have been around for a long time, but prior to 1973, when the Chicago Board Option Exchange first started trading listed options on the floor of the CBOE, there were really no standard behind what happens when somebody exercises an option contract. But they've been around for years, and all the way back to the Dutch aristocracy. There used to be option contracts that were traded on tulip bulbs, if you can believe that. But that's where the need for options came along. And hence the reason why we said in the agenda that we're going to talk about the premium of an option contract. Because there are a lot of synergies between the insurance world and the options trading world. And one of the synergies is the vernacular. If you pay for your car insurance premium, they say, well, I already used the word, that say you're paying your premium. If you buy an option contract, they say you are paying the premium for that option contract, and that's also known as the price of the option contract. And And other terms, like if you sell an option contract and you're in the industry long enough and you sell that contract without owning it, which is very easy to do in the options trading world, you would be considered the writer of that contract. And you would hear people say that from time to time. I wrote that X-strike call option on my 100 shares of stock. So you are considered the writer of the contract. If you buy an insurance policy from a company, they say, we're going to send the policy to our underwriters to try to come up with a premium or price for that policy. So they're called writers of the contract, and that's where underwriters come from. Same thing happens in the options trading world. So when we get down to the price of an option contract, this dynamic, if you need to start by approaching where the options market came from and to really get a good grasp as to why an option is priced the way that it is priced. Why is it trading for this number? How come there is this much time value? And just truly understand that an option is a contract and there are terms and conditions that are in each contract. And so whenever you see a quote on an option contract, all you're really seeing is a very abbreviated version of that contract. So I actually have the first book ever written on options, and they actually have pictures of written contracts that actually would change hands back before the Chicago Board Option Exchange first started trading listed options and made it simple to get in and out of option contracts without having to deal with writing up the contract, et cetera, et cetera. Okay, so in the options trading world, the biggest thing is that it's a contract between a buyer and a seller. The buyer pays a premium and can execute the terms or the rights of that contract. So I buy that contract, I have a right. I pay money, I get a right. Think of it in insurance term once again. I pay for my car insurance. I get a right to a new car if I drive my car into a tree on accident. So you pay money, you get a right. That's also the way it is in the option trading world. Sellers are then obligated to fulfill the terms of the contract. So I drive my car into the tree. The seller, otherwise known as the writer of the contract, has to give me a new car at this point in time. I don't get my premium back, right? But they do got to give me a new car because they are obligated to do it by the terms and conditions of the contract. Now, issued as a call or a put, calls contain the right to buy, where puts contain the right to sell. And that literally comes from just old terminology. And that, once again, we're coming from the sell side of the marketplace, and this is the way the verbiage comes from. But you say, I want to call stock away from somebody. That means that you have the right to buy it. On the put side of things, it means that I want to put stock to somebody. That means that you have the right to sell it, right? So call means I'm calling it away. Put means I'm putting it to you, and that's hence the way we say it nowadays is you are buying the stock and you are selling the stock. Now there's a lot of terms and conditions that go along with that, but here we go to start. So the anatomy of an option contract. So I am signing up for this contract. What quantity are we agreeing on? What product are we agreeing on, right? Back in the day, option contracts were traded on, more than likely it was on something in the agricultural world, but option contracts are traded on a plethora of different things at this point in time. The ones that we're going to talk about today, though, are going to be focused, I'm going to say stock options, just to try not to get too confusing, but we'll talk about a little bit more about the product. And what price are we agreeing to do the transaction at? And then lastly, what time frame are we agreeing on? Contracts have time frames, just like that coupon. If the coupon has expired and you stop at that store and you want that cup of ice cream for 50 cents off, well, too bad, the coupon's expired. That coupon ceases to exist. And in theory, right, you might still have the piece of paper, but It's worthless at that point in time. And that's also the truth if you're talking about option time frame and option contracts. All right, so the contract amount. One contract usually represents 100 shares of stock. And we'd always say usually 99% of the time it does, but weird things happen in the stock market. Like companies get bought, there's mergers and acquisitions, they do weird stock splits. So when that type of stuff happens, it will adjust the terms and conditions of the contract. I'm just saying that so that you know, but 99% of the time, if you're trading an option contract, it's going to represent 100 shares of stock. Straightforward. What product are we agreeing on? In our example, we're just going to use a fictitious company, but stocks, ETPs, otherwise known as ETFs, that just is short for exchange traded product. The most commonly known vernacular terms would be exchange traded funds. One of the most popular option contracts that is traded, and the most liquid option contract, is the SPY, the S&P 500 index, which is the ETF that tracks the S&P 500 index. Then you got indexes, currencies, commodities. We're just going to focus on stock today. That's really all that we're going to look at, because I don't want to make it, too complex here. So what price are we agreeing on? Well, they call that the strike price. So this is the price per share that the transaction would occur if the buyer exercised their right embedded in the body of the contract. And then what time frame? Time is money. You have more time. If you buy a 6-month insurance policy, that's going to cost you less than a 1-year insurance policy on your car insurance. And it's also very true in the options trading world. Normally on Fridays, most option contracts will expire on a Friday. Nowadays, though, they have a whole lot of different expirations. They have, if you go to the major indexes that trade options, a lot of them have an expiration that happens every single day of the week, Monday, Tuesday, Wednesday, Thursday. But normally on Fridays, and especially if you're just trading common stock. All right, so the quantity in our instance, we're just talking about one. So you're buying one contract that would represent 100 shares of stock. It would give you the right to buy or sell 100 shares of stock because we only trade one contract. What's the product? We're a fictitious company, ABC. What price are we agreeing on? In our example here, we're going to have a $1 strike price. And then we're going to go and look at the time frame. Now, I needed to change that back, but in our example, it's March 15th, which is 50 days away, which at this point in time would be December 27th. I changed it, forgot to go back and change it to March, only to fit along with the examples. This is the only spot I did that, though. So there's my little disclaimer on that. So the anatomy of an option contract. What quantity are we agreeing on? Well, one, that represents 100 shares. What product are we agreeing on? ABC stock. What price, called the strike price, is going to be $100. And what time frame? March 15th, 50 days away, expiring on March 15th. So now what are you going to buy? What type? Are you going to buy a call option? Are you going to buy a put option? Call option is the right to buy, the right to call stock away from you. Put option is the right to sell, the right to put stock to somebody. Now, we get into the tricky part of the options trading world. So, if once you purchase this option contract and say you are the owner, another term that we will use, you would be considered long that contract in your account. I'm going to buy that option contract, and then once it's in my account, I'm considered long. That means I own that option contract. Now, there are 3 different things that I can do with it once I own that. I can exercise that right embedded in the body of that option contract. I can let it expire. I can say, all right, I don't want to exercise that right. In other words, there's no benefit to doing that. The market went the wrong direction. And if it does expire, well, whatever you paid for that option contract is going to be your total risk, and that would be the cost. And I can trade out of it. Now, trading out of it is a little bit more tricky than trading stocks in that we've already said a couple of times that you can sell an option without owning it, and it's fairly easy to do in the options trading world. There are rules around it, and we can talk a little bit. We're not talking much about that today. But The vernacular, once again, if you're entering an order to buy an option contract, there's actually going to be an order ticket on your brokerage firm, online, on your phone, however you want to do it. And that order ticket will say, I'm buying to open or I'm buying to close. If I'm buying in a new position, I'm going to be buying to open. It's also the case if I'm selling an option contract, acting as the writer of the contract. I'm selling to open or I'm selling to close. And if that is the case, then selling to open, selling to close. If I sell to open, I then have to buy to close. So there's a method to the madness, and the exchanges will keep track of how many were marked opening and how many were marked closing to try to come up with a number of contracts that are actually out there active in the options marketplace. All right, so exercise, expired, or traded. Most of the time, people will trade out of their positions. As a matter of fact, it's about 70% of the time that people will trade out of their positions. The expired range of things, a lot of people there's a big misnomer that there's a lot of contracts that expire prior to the expiration, and that's actually down around 20% of option contracts that will expire worthless. And then if you've sold it, that's a good thing, so just keep that in mind. And then about 10% of option contracts actually get exercised on the marketplace, where they actually either buy or sell the stock, depending on if it's a call option or a put option. All right. So just keep in mind that most of the time people are buying that option contract and then selling it prior to that expiration date. And we'll talk a little bit of the reasons why. And like I said, almost 70% of the time people are going to buy to get in, sell to get out, or sell to get in and buy to close to get out. All right. All right, so Veronica asked a question, and I think it's pertinent for right now. Why? I'm going to answer most of these questions at the end of the show. Why is it that some option contracts are showing a bid price of 0 for weeks or months? Well, it could be the fact that it's not worth anything. Bottom line is, we're saying here that our strike price is $100, and let's say make it simple and talk about a call option. Well, if I have the right to buy that call option, and I'll make it ridiculous, at 130, and the stock is trading at 100, well, there's really no benefit to that. And so that option contract price will reflect that in that point in time. And it's that simple. The probability of the stock getting to the strike by that expiration, it's a long ways away, and that's why it's trading for next to nothing. And it can do that for a long time if you're far enough out of the money. In this case, if it was 130, the math is simple, you're 30% out of the money. You know, it takes sometimes 3 or 4 years for a stock to move 30%, depending on the underlying stock. Not the ones that get covered on the financial news networks, right? Those move day in and day out. But normal stocks usually don't move 30% in a month or two time period. All right. Now, when it's all said and done, once again, you're paying the premium. You're paying the price for that option contract. And we call it the premium one. It comes directly from the insurance world. All right. SPY has, Gerald made a comment that SPY has daily option contracts also, and that is true. A lot of the major indexes, well, that is an ETF that tracks a major index. So that's usually where it's at. And I see a lot of great answers. A lot of people came up with the term protection when I first asked that question. As a matter of fact, I don't see anybody that said it was speculation. So that is that is a good thing. That's a good sign. People are becoming more and more astute in the options trading world, and partly because of companies like ours, OptionsPlay, out there trying to educate the population. All right. Oops, I just need to click that. Okay, so this is kind of my favorite slide in the basic option trading world, and I'm just going to run through the builds here. But you have 4 different things that you can do with an option, and I kind of went into that on last slide, so I'm going to go through this fairly quick. But if you are the buyer of an option contract, you pay, you get a right. What's that right to do? It's the right to buy the stock. So if I buy a call, I have the right to buy stock. If I sell a call, I take on an obligation. What's that obligation to do? To sell stock. So once again, the term call comes from the sell side of things, where they can call stock away from you. And that's why they call it a call option. If you're thinking about a call on the buy side of things, who am I going to call, right? Ghostbusters? In general, on the buyer side of things, if you approach it from that aspect of it, it's kind of hard to understand why it's called a call. On the put side of things, well, if I am a seller of a put option, I'm going to take on the obligation to buy. They can put stock to me. Now, if I buy that put option, I am going to have a right to sell stock. So, puts are very hard to ask questions about. And I've been doing this for like 30 years, and I still sometimes screw it up, because buy means sell. If you buy, you're intending to sell at that strike price. Okay, so if you sell a stock, well, you're doing that because you think the market is going to go down. You think the price tomorrow is going to be lower than it is today. So this is one way that I can get bearish on the market, is to buy that put option. And it's a simple way to do it. In the stock trading world, you have to sell stock short. And you got to borrow the stock from the brokerage firm and sell it and then buy it back at a later date. And that's one way that you can get bearish on the marketplace. But with put options, it's fairly straightforward. Now, on the other side of things, once again, call options are just easier to understand. But if I do buy that call option, I am intended that the underlying marketplace will go up. So that begs the question. If you buy a put, you're bearish. You buy a call, you're bullish. If you sell a put, what are you? Well, you're also bullish, right? Because that means that they have the right to put stock to you. You'd like the stock to go up because you got a fixed price. If that price is higher than where your fixed price or strike price is at, well, then why would they put the stock to you? You get to collect the premium. It's just like saying that if I sold a car insurance policy, I'd hope that they don't run into the tree. Right? I hope that that car appreciates over time, and I don't have to buy them a new car, which they almost always depreciate. Okay. Shoot, how did that happen? Okay. And on the call side of things, if you're short a call, well, if I'm long, I'm bullish. If I'm short, I'm bearish. Same scenario, exactly what we're saying. Okay, how is an options priced? Well, here's the premium, and the premium is made up of the extrinsic value and the intrinsic value. Now, that's just a fancy way of saying the amount that it is in the money, which is a fairly intuitive concept in the options pricing world. But extrinsic value is just time value. And so if you have some value in your option contract, they will call that they'll call that the intrinsic value, or the in the money amount. Now, any premium above and beyond that, they call time value. But once again, if we go into the insurance world, different stocks have different risks, just like different car drivers have different risks, right? Am I a father of 4 and a teacher and drive a caravan? Or am I a Navy SEAL that just got out of training and wants to drive no kids and wants to drive my car off the cliff just to see if I can survive as a training exercise, right? There's a difference in mindset between those two. And because of that, the insurance companies will price them differently. That's why they ask these type of questions about your job, about what you do. Okay, in the options trading world, right, Tesla is going to have a little bit more volatility, even though they consider it a car company, than Ford. They just trade differently. They both sell EVs, but obviously when I say those two, there's a difference, first of all, in the overall price of the stock, and then second of all, just about the fact, just the way that they trade and how they work. So that's a great example. So how do we test that? We'll call that component the implied volatility. And we'll go around that a little bit more, but there's also times when implied volatility can be higher. If you think of insurance, let's now talk about, unfortunately, we've had a few hurricanes recently. And if you're trying to buy homeowners insurance, once it's announced, or during hurricane season in general, let's just say, you might be paying a little bit more premium, only because it's that risk of that impending hurricane that could happen can drive up the price. And nowadays it's harder and harder to get homeowners insurance if you live in areas where there's a high potential for a hurricane. Well, it's not a great example, but in the stock trading world, earnings is by far the biggest thing that can increase volatility. It's an anticipated date, everybody knows when it is, and that can drive up implied volatility around that date. So keep that in mind, that there is a component that's called time value, and that's pretty mathematical in how you figure it out. This is the big question mark. This is what you have to, the market makers and the option trading world has to try to get right. How much of this extrinsic value is made up of time value and how much is implied volatility? We'll try to get into that a little bit later. All right, let me see if I got a couple more questions. Okay, so we got a question about just pricing calculators in general. And yeah, Bernie, if we get to there, maybe we can do that. I did throw a couple of slides in last minute just to maybe talk about options pricing and options pricing calculators, and maybe we can get to that. All right, Bernie? All right. Well, I should have probably went to these builds, but I didn't. Internal factors, in the money is in the money, right? The math is really simple. If it's got $5 of real money, intrinsic value, it's going to be trading for $5. And then I went through a lot of detail on the external factors. Okay, building our example. And I'm going to just run through these first two ones fairly quick. So for example, our underlying stock was stock ABC. ABC company, fictitious stock that does not exist. Last price was 103. Premium here is made up of any of the intrinsic value, if it has any, and extrinsic value. So for example, our right was to buy at 100, ABC is at 103. Is that good or bad? If I have the right to buy the stock at 100 with the stock at 103, would you want to do it? The answer is yeah. I would like to own the stock at 100. So I could call stock away from somebody at 100 if this option was a call option. And if that is the case, the stock is at 103. So it has $3 worth of intrinsic value, right? And this is a 30-day call. Not that that matters a ton, but we are going to talk about, I didn't highlight that. All right, so now we go in and we see that the total premium is $5 for our option contract. And so we know we have $3 of intrinsic value, quite simple. We're in the money $3, we take 5 minus 3, and that means we have $2 worth of time value. So this option contract is considered an in-the-money option contract. That means that I would like to exercise. If I had my ruthers, I'd rather exercise than not. And if I did exercise, I'd buy it at 100, could sell it on the market at 103. That is what it's intrinsically worth. But you look at the price, you see it's for $5. And so that extra 30 days of having that privilege to buy the stock at 100 will cost you an extra $2. And we'll call that the intrinsic value, or often referred to as the time value. So these are examples, and I'm going to run through them. I'm just going to throw them up here because I think they're pretty straightforward once we get to, once we've gone through what we just went through, right? So we still have ABC stock. Last price is now 105. If we looked at the 95 strike call, well, is that in the money or out of the money? Well, if I exercise my right and then sold, would I make money? And the answer is yes. If I did that, it's at 105, so I would buy at 95 via the option contract by calling the stock away, and I would sell it at 105. So if we look at that, we have $10 worth of intrinsic value. Guess what? It's got to trade for $10. That simple. It can't trade for less, because if not, there's going to be an arbitrage opportunity down on the trading floor. So we know it's got to trade for $10, but we look at it and we see that the last price was actually 12. That means 10 minus 12, $2 worth. Oops. Dang it. $2. I gotta stop clicking this button. $2 worth of time value is left in that option contract. So if it's a 100 strike option, well, then as usual, as you get closer to the strike, here's probably one thing that's worth highlighting is that we do have $5 of intrinsic value, but the time value becomes a little bit more of an issue, more of a factor, right? $5 is intrinsic, $3 is time, and that really has to do just with the speculation and overall cost, because even though it's got $3 worth of time premium, it's trading for more time premium, you still are trading, it's still less expensive than if we bought the 95 strike call in this instance. So as it has a tendency to happen with option contracts, the most at-the-money option contract is where this technical term, all the juice is on the option contract, because a lot of people are speculating, will it go in, will it go out? So you get a lot of bang for your buck on an at-the-money option contract, something that's close to the strike. But when you're doing that, though, you still you pay up. You pay up for that right based off of that information. It will be trading for less than in the money option contracts, but a lot of times that's where all the time premium will sit. Now, if we go equidistance in and out of the money, here's another little interesting little tidbit about option pricing is we're $5 out of the money in this instance. Well, here's actually the 105. This is the at the money. The 105 strike is the at the money, and hence we're paying $2, $3, $5. Now, if we go to the 108 strike call, that's all out of the money. There's zero intrinsic value in both of these cases, and that time premium is $3 or $4. Okay, so this is 5 points in the money, and I thought this was going to say 105, or 110, but it doesn't. Okay, so this is 5 points in the money. It's trading for $3 worth of time premium on a 30-day option contract, right? 30 DTE means days to expiration. So in this instance, if we looked at the 110 strike, can anybody tell me what the time premium would be? If we're in a theoretical world, we're not talking about bid and ask or whatever, put it in the chat box or in the Q&A. Have a guess. We know that this option contract is trading 5 points in the money, and these are the intrinsic and extrinsic. What if we look at the 110 call option, 30 days out of the money? What do you think it's going to be trading for? First answer is 2, and I'm going to say nope. $5. Bernie says 4. Nope, that's the 108 strike. We don't quite got it yet. Now this is a little bit advanced. 9. No, not of the money option. There we go. We finally got it. Vince, it's 3. And then the 3s are starting to roll in. And that is correct, because equidistance in and out of the money in a theoretical options world, time is time, right? So you get the benefit of intrinsic value of $5 here, but the time premium is actually $3. So you go 5 points in the money, you get $3 worth of time premium. You go 5 points out of the money, you get $3 worth of time premium. So equidistant in and out of the money, in the theoretical world, there's going to be different things that will happen in the real world, but it's usually fairly close, fairly accurate. You will see that the time values will be the same. The value of the option contract will not, because you have real value, intrinsic value, and out of the money options do not have any. But it is important to note that if you straddle the stock and you say, all right, I'm going to go 5 points in the money to the 100 strike call option, and it's trading, and I see that's trading for $3, well, then I would know what the 110 is trading for, 5 points out of the money. I would also know that's trading for $3. Mike says a bit difference for puts and calls. It is in the real world, once again, Mike, but in the theoretical world, it shouldn't be. Okay, so there's a little bit, but we're talking pennies. We're talking pennies, and I guess it does matter. It has something to do with futures markets and stuff like that. But ideally, it is. There's a rhyme or reason as to why it's a little bit different with puts and calls, but that's beyond the scope today, 100%. All right, so inside the Options Play software, we will highlight this for you. Okay, so this example was not that long ago, but Apple was at 196. It was up 95 cents on the day. And here is our days to expiration. It will tell you where the days to expiration is, and it will tell you out of this time premium, what is the implied volatility for that option contract. And once again, that is the mystery. And if we get a time, maybe I'll jump forward to a couple slides that I added to this presentation. But in all of our examples here, we have three different examples. We have the 195 strike, which is in, the 205 strike, which is out, and the 205 strike, which is the most at the money. That's going to be, okay, we don't have an at the money. And then we're out and we're out. Okay, so 205, 195. Once again, I thought that's at, out, and further out. All right, so let's look at intrinsic value versus time value, and let's do just a little bit of analysis here. All right, so if the market is at 195, we're talking about a March 15th call, it's 50 days to that expiration date. We would see that this is trading for $7.10. If you bought one of it, one call option, it would be $710. We take the price of the call option, 195, and we subtract 195 from 196.13, and you see that this option contract trading at $7.10 has $1.13 worth of time and $5.97 worth of of time and $1.13 worth of intrinsic value. If I exercised and sold, I would get $1.13, but that would also mean I get the stupid award because I could have sold it on the market, right? And captured all of this time premium. So that leads to the discussion that I had about exercising, trading in and out of the position, and letting the option expire worthless, right? Most of the time, people don't want to exercise and buy the stock if there's time premium in that option contract, because it behooves them to sell it on the options marketplace. Now, in this instance, we're way out of the money. No intrinsic value. 205 is quite a bit higher than 196, but it's a 50-day option contract, and the marketplace has determined, based off of the risk factor, or what the marketplace is implying the volatility of the stock to be over the life of the option contract, that's worth $2.61. 50 days is worth $2.61. Here's the cost. If you bought one contract, $261. If you bought two contracts, it would be double that. That's straightforward. All right. And then lastly, we got the 210, which is even further out of the money. Since it's so far out of the money, it's going to be trading for less. And the further and further I go out on the scale, it's going to be trading for less and less and less. And then we would get to Veronica's question. Well, what if it was trading, what if you're buying the 250 strike call? What would that be trading for, Veronica? Answer is zero. Why? Because you're so far out of the money on a 50-day option contract that there be little benefit to owning that contract. The probability of it getting to the strike, and that's an important thing here too, by the way. Another way to say implied volatility and what this implies is if you have higher implied volatility, there is a higher probability that the stock is going to get to this level. That simple. If we stay in the mega cap tech world, which stock do you think is more volatile? Would you say Amazon is more volatile, or would you say Apple is more volatile? They both announced earnings last week, actually, in the real market world. What do you think is more volatile? Well, I'll just cut to the chase. I'm sure most people will say that Amazon is more volatile. AMZN is the symbol. Thank you for that. And yeah, that's true. So guess what? An option contract that is, and I'm just going to round off here, that is 9 points out of the money, like this option contract is, on Amazon is going to cost you more. And why is that? There is going to be a higher implied volatility because the stock has a tendency to be more volatile. And that implied volatility increases the probability that it might reach that strike price, and hence the reason why you would pay more for it. And it's that simple, that straightforward. I'm wondering if I want to go there. Okay, 1 second. Yeah, let's do it. Let's do it. I'm going to have some fun. I'm going to go on a tangent here, okay? So 195, one here is 140. All right, let's look at this call option. You got to bear with me here. I need you, take a swig of the coffee, slap your face a little bit. I mean, it's an option seminar. Let's wake up. Here we go. This is to go along with implied volatility and probability, which are very high topics, right? You can rewind this if you need to listen to it again, if you're a very basic option trader. But let's say that you buy this option contract. According to our thing, we're going to round it off and say there's 50 days to expiration. DTE, days to expiration, 50 days. We're going to say that this is, I guess we'll be a little bit, we'll say this is 196, and we are going to, so it's 14 points to get to 210, to get to the strike. Would everybody agree with me that my degree's in math, but sometimes I struggle when I'm in front of a crowd doing it, but 210 minus 96 is 14. So here's the scenario. Right now it's trading for 140, and I'll be very impressed. We're in a theoretical world. Nothing else is changing. Implied volatility is going to stay the same, but we're going to change the price and we're going to change the time. And so in this instance, it's at 140. Let's say the stock went up $7 and it took 25 days for it to go up $7. You bought this option contract on day 50 and the stock was at 196. So now it's at 203 and this gets cut in half. This slider goes all the way down to here. Well, yeah, that's extra. It would go all the way from here all the way on down. It went up 7 points and it took 25 days to do that. All right, here's my question. And I want everybody playing my reindeer game on this one or I'm not going to go on. I need to get some answers. What's it trading for? Just guess. What do you think this option contract right here, this one that I'm pointing at on the screen, would be trading for if it went up 7 points and it took 25 days to do it and everything else in the marketplace stayed the same? First answer is $1. Second answer is $5. All right, I'll buy it at 1 and sell it at 5. Look at that, I just made $4. That's called arbitrage. I hope somebody chuckled at that. Next one, 70 cents. A great little answer says depends on the delta. You're making it too complex. Rufus comes out with, actually puts a decimal in here and says 125. All right, that's enough. That was fun. Since I already arbitraged Summit and sold it to Vince, and I made my $4 on the day, that pays me for doing the seminar, I guess. Bought it at 1 from Summit and sold it to Vince at 5. My eyes aren't as, I hope I'm saying those names right. But with that said, you know what the answer is? 140. You paid 140 for it when you put it on. It went up half the price, and I gave you the hint when I said that it was 14 points. It went up 7 points, which is half the price, and it took half the time. So think about this. When you put it on, there was a probability of that stock reaching that strike. That probability was determined by the marketplace via the implied volatility. Did anything change in our probability? Now remember, we're in a fictitious world. Rufus is fairly close at 125. I mean, I'll say that's within the degree of error on 125. But if you look at this and you think that the probability really hasn't changed, the price really shouldn't have changed. And that's my point. And now I do see a couple of people say, yeah, theta decay on calls goes again. I agree a little bit, but you're still out of the money. And especially, so if you throw this into an options pricing calculator and you're dealing with a 50-day option contract, yeah, this is really going to be the case. You don't change implied volatility, you don't change interest rates, you don't change anything else. You will see that on a 50-day option contract, this scenario will be the case. This will be true. If you're talking about a very short-term option contract, well, you're probably not right in that options will decay at an accelerated rate as expiration approaches. I know that's an exciting concept. You might want to have to stop and text all your friends and family and let them know that. But when you're this far out and you're talking about a 50-day option contract becoming a 25-day, it's not that rate of decay isn't that huge on a one-to-one basis. And yeah, my scenario is correct. And you'll see it. If you got access to an options pricing calculator, go there right now. You can play with it. You can get it. You can see that I am correct on this. The probability of it reaching that strike price did not change. So the price did not change. Now, in the real world, never does anything stay the same, right? Implied volatilities can fluctuate. All of a sudden, there's a known event, a big news item comes out. All these different things can happen. So this is the theory, but to me, it's very important to understand the concept, because this is why you might buy this option contract as opposed to buying this one. You can buy three times as more, right, for the same amount of money. But if the stock doesn't get to that strike in time, you're going to be out that entire investment. If the stock went up $7 on this option contract, guess what? You made money. Why? Because you had intrinsic value. It moved more than the time value, and you made money. This one, you lost your entire investment, right? If you rode it all the way to the 50 days and it went up $7 at expiration, you're still out of the money. And you did not make any money on that trade. And that's probably, I also have an article on my website actually called The Top 10 Mistakes That Option Traders Make. My website is OptionsPlaybook.com. And I'm the author of the book. And also I work with Options Play. I work for Options Play. So with that said, where was I going with that? Okay, so as far as options are concerned, oh yeah, top 10 mistakes. Guess what the number one mistake is? Beginning option traders buying out of the money options because they didn't understand this concept that I just taught you. So instead of even buying the 261, why would I buy the 261 priced option contract when I buy the 140? Well, there's a lot of different dynamics between the two. And it's all about volatility, which translates to probability. So moral to my story, and I'll get off my soapbox, is it's more about probability than anything when you're talking about out of the money option contracts. Oh, thank you, Mara. Best book ever. I appreciate that. Well, I put in ever. She just said best book. Maria. Yeah, I can't quite see those names for some reason. Appreciate the comment. All right. Here we go. I guess I can go through this again, but we just did it. And you know what, this is extrinsic value, and we're talking about that versus time value, but we just went through it. And I actually took extra time to go through the real life example on Apple that we went through. But everything that we talked about, intrinsics versus extrinsic, underlying stock, we're talking about call options. Yeah, I don't see a need to go through all of this once again. The slide will be available to you. Okay. So now if we go and we look at different option contracts, and we talk about the 195 strike call, and you got 2 days remaining to expiration, look at what happens to the difference in time value, right? Now we see that intrinsically with the stock at 195, so they took these screenshots at different prices, 195.91, and we're talking about, we got $91. We see that it's trading for $1.91. So the time premium in this instance would be $1.91. And here's the big difference here too. When we go out to, from the January in this instance, we had, it doesn't show me the DTs. Well, the February call option with that same strike is now, oh, there it is right there, 2 DTE. Here is the 30-day. Obviously, you're going to pay more. You go out to the March 15th, 50 days away, you're going to even pay more for that. But one thing that is a big difference to note from here, and this is actually summarizing time decay. Like I said, as options get closer and closer to expiration, they decay at a more accelerated rate. And you see that from the 51 to the 30 here, in this instance, that's 21 days. You're going to lose less than $2 on our option contract. But if we go from the 30-day to the 2-day, we're going to lose more than $3 on our option contract. And that just highlights the factor that I said to you. Options decay at an accelerated rate. They actually decay at the square root of time if you want to get really fancy about it. And that's actually one of the things in the theoretical world that really applies to the real world. But all you got to understand is that the rate of decay is, the square root of time thing is what I'm trying to emphasize, but is that options will decay at an accelerated rate as expiration approaches. But there's other dynamics that go along with it. Okay, so at this point, since I went through that and I had Bernie ask a question way back when, guess what I'm going to do? I'm going to go to the slides that I put in. Bernie said that he wants to talk about option pricing calculator. So I threw this in just in case we got there, okay? Just in case I got that question. So I think I'm going to go through this example, and we'll pull up maybe the option play software, and we'll look at a couple of scenarios that will highlight the differences between the different expirations. But if we look at this and we're talking about an insurance contract and we talk about the options world. So let's pause for a second. Let's take a breath and let's go back to where I started. Where did the options pricing vernacular come from in the options pricing world? And where it comes from is the insurance contract. So if I am buying a car insurance policy and I look at the price of that asset and I give all my information to Geico because I like that little lizard. So I give them all my information. They say, first of all, what are you driving? Are you driving a Bentley or are you driving a Ford Taurus? There's definitely a difference between those two different vehicles, and the price of the asset matters. Now, this is one thing that people don't really get in the options trading world, but I mentioned Tesla and I mentioned Ford. So an at-the-money 30-day option contract on Tesla, just because of the price of the underlying, is going to be worth a lot more than an at-the-money option contract on Ford. And it's all about that price of that asset. It's not about the fundamentals of the company, but if you're using an options pricing calculator to determine it, the price of the asset matters. It's more expensive the more pricey the asset is. And then we have a deductible. So in our world, if we really want to think about insurance, we have to think about a protective put, right? I own 100 shares of stock. Stock is at 100. I buy the 95 strike put. Means if the stock goes down below 95, I could take my stock that was at 100 and it's now trading at 90 and put it to somebody at 95, right? Well, in this world, in the insurance world, that strike price would help determine the deductible. Most people don't buy the zero deductible insurance because it's very pricey to do, and a lot of insurance companies won't even sell it. So do you want to pay a $500 deductible or a $1,000 deductible? If I pay a $1,000 deductible on my insurance policy, it's going to be a lot cheaper. And then time is time, and just like everything else in the world, time is money. That's what Mama always said. Cost to carry. Now, a lot of people don't think about this when it comes to your car insurance, but when do you pay for your car insurance? You want a 6-month policy? Do you pay it at the end of the 6 months and say, okay, I didn't get in an accident, here's my money? Or do you pay it at the beginning of the policy? And of course, insurance companies are smart. They can earn interest on your money. So you pay up front, and then they take those monies and they can invest it. And the concept in the insurance world is that if they did very good on their investments, and you're an insurance company that is better than other people at managing money and making money off of your money, then you can come back and give them a discount on the next 6-month policy. I mean, that's in a utopian marketplace. That's how insurance would be taken care of. But bottom line is, they get the money up front. Recently, interest rates, on a 6-month or a 2-year T-bill, you could end up getting 5%. Those are money market funds and interest rates. So that matters. That matters in this insurance cost. All right, level of risk. I already talked about that. Are you a teacher, father of 4, driving a caravan around, or are you a Navy SEAL driving around a Mustang and, just like to do things to see if you can survive as a training exercise? So that level of risk is real. And that's why a lot of times you'll see different insurance companies that will apply different actuarial tables to the different scenarios of the people that are buying them. So level of risk is a real thing, and it does affect your insurance policy. I guess my best example would be they give breaks to people that turn 25, right? Just the fact that they've turned 25, they've done the math and said, you're not a kid anymore. Your brain has developed to the point that we think that you're going to be a little bit safer driver, and the math has showed that that is true. So that affects your premium or the price of your option contract. So now in the options trading world, well, the price of the asset is the stock price. Tesla versus Ford. Deductible, that's the strike price. In my scenario, we talked about a stock being at 100 and buying the 95 strike put, the right to put stock to somebody at 95. That's the $5 deductible. On 100 shares of stock, the difference between the stock price and the strike price is $5. That means $500 is your risk if you owned 100 shares of stock. So remember, I'm talking about this as a protective put in that you own 100 shares of stock and you buy a put. That's the easiest scenario. All options can be approached from the insurance world, but that's can be talked about from the insurance world as insurance contracts. But that's the easiest scenario to grasp. Time is money. Interest rates and dividends. Now, Ford doesn't pay. You drive your car around for 3 months. They don't come out and say, oh, good job driving the car around. Here's a dividend. Thanks for driving our car. But the stock market does. And when you pay for your call option that you buy, or your put option, I guess in our case, when do you pay for it? Do you pay it at the beginning of the term, or do you pay it at the end of the term? Well, you pay for it up front. So the person that gets that's the writer of the contract, no matter who it is, market maker or another individual retail client like yourself, they can earn interest on that money. And they get that money, no matter what happens. If the stock gets put to them or not, they still get that money up front. Just like your car insurance. If you drive your car into the tree, you don't say, yeah, you are correct. I am a bad driver. Give me my premium back and my car. No, premium is a cost to have that peace of mind that if you did drive your tree into a car, or your car into a tree, that an insurance company is going to give you a new car. All right. We call that volatility. And more specifically, we call that implied volatility in the options marketplace. What the marketplace is implying the volatility to be over the life of the contract. We did an example between Apple and Amazon. Everybody that was in the room basically said that Amazon was more more volatile than Apple, pretty straightforward. And then there's the obvious one, Ford and Tesla. There's a huge difference between the volatility in a Ford and the EV maker Tesla. All right. You take a pricing calculator. This is where the pricing calculators came from. All the same concepts that go into an insurance contract were used by Fisher Black and Myron Scholes back in 1973 when they made the first pricing model. They built it off of things that are involved in an insurance contract. So that's simple. If you look at this, you put all these things in, you can find all of these things, but you know what's the biggest unknown is this volatility number, right? I can find the stock price. I just got to get a quote. Go to the Options Play platform. You can get a quote on the stock. If you can't find the strike price, well, then you probably shouldn't be here right now, but the strike price is pretty easy. I can count back to days to expiration. I don't need to on the Options Play platform, but if I have to take my shoes off or whatever, I can figure that out. Interest rate's a little bit tricky, but you want to look at the risk-free interest rate. Dividend yield is dividend yield. But volatility, that's kind of the question. So when you see volatility in a lot of brokerage platforms, including Options Play, we actually will solve for volatility. We will take these components in and put them in a pricing model, and we'll say, this is what the marketplace is implying the volatility to be. And so we take all of this information, and guess what we do? We just do simple algebra, and we put implied volatility. We take it from here, and we put it down here, and then we take the premium and we put it up here. And bottom line is, if you know the price of the option from just getting a quote on it in the options marketplace, you can find the implied volatility. And in the retail options world, that's the implied volatility. It is what it is. In the market makers world that are making markets on the exchanges, they're trying to tweak that number. They're trying to say, oh, this is what the marketplace is implying, but we really don't think that, I don't think they did this right, or you got to take this into effect and all this. And it's true in the car insurance world too, right? Why does Geico have a different price than Allstate? And it's all about how you are judging the risk of that driver. It has everything to do with why one insurance company might have a different price than the other. There's other things in it. It's a little bit simplistic to say it that way, but bottom line is that same type of thing happens with market makers down on the trading floor. All right. I am happy to answer any questions that you have. I'll put the slide back up. If you'd like the free trial for Options Play, we have a plethora of education. We have this entire row over here that will help you pick option strategies, will help you search for stocks. You can look for them fundamentally. You can look for technical analysis that goes along with them. We'll throw you in different trades that you can do. It's worth checking out. No obligation whatsoever. You got to get up an email address, and that's about it. And if you do that, and you like it, please do sign up. It helps pay the bills for this free education that we like to put out there. All right, my name is Brian Overby. My handle is on x.com is my name, @Brian Overby. If you want to learn more about everything that we talked about, you can actually scan that QR code, or you can just go to optionsplay.com. And as I mentioned, my website is optionsplaybook.com if you want just some more free education. And if you have any questions, I'll try to address them at this point in time. All right. Now let me actually, I know I'm scared I'm going to lean forward a little bit here. Because I'm traveling today, and I got my computer set up a little screwy here. Let's go over to the Q&A to start. So I'm in the Q&A box right now. If in your experience, what is the best and worst day of the week to open a new contract? Okay. It's all about, there's no golden book of answers to that question, Lim. It's all about your forecast. One of the things if you're saying what is the best day to open and close, first of all, you got to tell me if you're buying or selling. And then second of all, it's really about your outlook. Okay, so I'll tell you that recently I do a lot of the research for the daily play inside the options platform. You'll see my ugly mug almost every day, unless I'm traveling, to where there's a video that I will talk about an option strategy. And the most recent one that I did with 1 day remaining expiration was on Amazon. And basically my outlook was if Amazon talks about their AI strategy, they have a good one and the stock may go up. And because of that, they announced on a Thursday, there was the Friday expiration. Guess what? We used the Friday expiration. Now that Amazon's announced earnings and there's not that known event, as soon as that gets done, now if I were to buy Amazon and I was going to buy a call option, I would do it because of fundamentals, right? I would do it because going forward, I think that I liked what I heard and I just want to own it for the long term. So I might go out 6 months, I might go out 4 months. I might buy some intrinsic value because of that. So there's really no golden book of answers. It's really about your forecast and what you were trying to accomplish. Gave you 2 scenarios, but Amazon, both of those scenarios worked for me. I liked the stock going into earnings because I was excited about AI and what they might say in their conference call. So I speculated on 1 day, 100% speculation, prepared to lose whatever I traded. And now I'm not prepared to do it. I want to buy some real value on the option contract, and I would look to hold it for over 6 months or beyond. Now, once again, this is not meant to be a recommendation, but I'm trying to give real life examples about how I might approach 2 different scenarios in the options trading world. Okay, so that one's there. I hope that answered it. I think it says Lim or Jim. It might say Jim, I'm not sure. Carl, okay, I can see that that says Carl. Carl says thank you, I'll give you that. I'll say you're welcome. Where do you find the recordings? Well, it's on YouTube. You can find it right there. And then also if you click that QR code, and I'll go back to it, we will post a link to it inside this. So give us a day or 2 and it will be in there. That simple. That's the easiest way to do it. Can you give your website? Yep, I already did, optionsplaybook.com. I'm the founder of Options Playbook Incorporated. Okay, and then Jonathan, if you are long a call that expires in the money, do you get assigned on the stock? Yeah, that's a great question, Jonathan. Yeah, if I am in the money and I don't do anything, I will be assigned. And the Chicago Board Option Exchange basically says that if your option contract is, and I'm going to be really blunt with you on this, if you are 1 cent in the money, you will own 100 shares of stock if you have 1 contract on that underlying. And that is an issue because they're assuming that you want to own it. Some brokerage firms, if you're trying to buy 100 shares of the SPYs, which is a $500 stock, right, the SPY, they might close it for you and not let it get to the Options Clearing Corporation to get exercised. Because if you don't have enough capital to buy 100 shares of a $500 stock, you know, they might take it upon themselves. But with that said, if you own an option contract, never assume that it's not going to get in the money because you might wake up to a big surprise in your account. All right. Do you train students? Yeah, well, we do. We do here. We do via this, but we do not at this point in time have a mentoring service. We don't at this point in time. It might be coming. Who knows? Get the point about out of the money. Okay, the bid is 0 and ask, it says 25. Can you buy? You can buy but not sell. Yeah, that's correct, Veronica. Veronica says that if I do see, let's say the bid is 0 cents and the ask is 5 cents. Veronica's basically saying you could still buy that, right? Yeah, I mean, the math says you shouldn't, right? The marketplace is telling you that it's a worthless option contract if it's trading for 5 cents. but somebody will sell it to you for 5 cents. If that asking price, if that price is there, you can buy that in theory on the marketplace. But then Veronica says, but then I can't sell it. No, you can't, because the bid zero, that means there's no buyers that are willing to put up a price and take the other side of your contract if you are selling to close that 5-cent option contract that you just bought. The stock would have to go up if it was a call option for it to have some valuation. Did you calculate the fair value of an option each time you took a position? Frank, no, I did not. And that's actually a really great question. So let me say it again slower. Did you calculate the fair value of an option each time you take a position? The fair value is what the market is. And so this goes back to that conversation on implied volatility, on how I might calculate implied volatility. I'm not getting into the minutia. I have the benefit as a retail client, and this is a benefit. There's a detriment too, but the benefit is I determine what option contract I want to buy. I determine what expiration. I determine if I want to be bullish and buy a call, or if I want to be bearish and buy a put. The quoted price is the fair value. That's what it is. If you try, and I used to have, and this actually is a chuckle, but I used to have people call up and say, and answer the phones. I was a broker way back in the day on Charles Schwab's option trading desk, 30 plus years ago, and everything was done via the phone. And people would call up and say, I got a quote on this option contract, and I was buying an out-of-the-money option, and the quote says it's trading for $3.25. I just ran a pricing model, and the pricing model says it should be $3.15. Can you call the floor and ask them to update their quote? So if you didn't chuckle at that, you might want to watch the show again, just so you know. But the market is what the market is. We're retail clients. We're not trying to trade for nickels. We're not trying to get pennies on each and every transaction. If I'm a market maker, the big benefit to me, which is a detriment to you, is exactly what Veronica talked about. If you are buying that 5-cent option contract, I'm selling it to you for 5 cents. I think it's worthless, but if you want to pay 5 cents for it, I'll sell it. But I won't buy it from you at 0 cents, right? So if you go turn around and want to sell it, well, I don't have a market. I'm not going to. But bottom line is I make the difference between the bid and the ask as the market maker, but I don't know what I'm doing. So I may run calculations to try to determine if this is a fair value or not a fair value on the options price, and leave that for them to do. If you look at it and you see the price of an option contract, that's the price. You buy it or don't. If you really think it's overvalued, sell it. Come up with a strategy where you can sell it. Right now we're highlighting credit spreads. That's a strategy where if you think options premiums are too high, you can sell some credit spreads. That's simple. All right. Frank says thanks. All right, now I'll address a few more of these, and we're almost done here in this situation. Oh my gosh, these are more just comments. Thank you, thank you. Can OptionsPlay tool integrate with my Fidelity account? The answer is yes, Kim, it can. I don't know the 100% ins and outs of that. That would be a question for Tony, a little bit more, but yes. There is an API access to option, as far as I know, to option trading from the OptionsPlay tool into the Fidelity account. A lot of thanks. Excellent webinar. Appreciate that. Are there any general stats on what types of traders are there who trade options? So someone asks a little bit more about on who's trading the options. Are they traders? Are they hedgers? Are they doing it for income? Are they doing it for insurance? Are they doing it for speculation? And that's so hard to judge. There are no stats. And yeah, there is trading software out there to know that if somebody came in and somebody buys a lot of an option contract, There are some softwares out there that will do a search and say that person bought that contract and paid the asking price for that contract and say it was a call option. So that's implying that they were bearish when they did that. Now, that's not 100% accurate because you don't know why they're doing it. A better example would be on the put side. If Apple's going into earnings, and I actually mentioned this on a recent podcast that I did, but Apple has a tendency to sell off after earnings, and it did again. Amazon went up, Apple went down. So if almost everybody at every brokerage firm I've ever worked at owns some Apple. If you buy stocks, a portion of your portfolio is probably Apple. And even if you don't actually own the stock, you probably own an index that owns Apple, right? So you own it in some way, shape, or form. So if I go out and in my account, I have 100 shares of Apple and I buy a put going into earnings, does that mean I'm bearish on Apple? My best case scenario is that the market doubles on the upside and my put expires worthless. So those are the tricks of the options world to try to figure out if they're speculating buying insurance. So there's really no way to do it because of a great scenario that I just gave you. Okay. Different brokerage firms have different implied volatilities. No, different brokerage firms. Well, I guess I would say, the question comes from who I am buying or selling to determine the trade. Different brokerage firms have different implied volatilities. No, that's really not true. Implied volatility is implied volatility, but here's the case. Different brokerage firms may have different models. And so let's say you're doing, and I'm going to be very generic. Names that you might know, the Black-Scholes pricing model versus the Cox-Rubenstein model. You might get a different number based off of the model that you're using. But in general, implied volatility, especially if you're getting it from a quote provider, is going to be, pretty uniform across the board. And it's not an exact science when you are you're talking pennies and that, and you're a retail trader, that shouldn't matter as much. And I say that with trepidation, but all right. Thank you for the nice comments, and that's going to be it. Please check out the free trial. I'll leave the scanner up there for you, and I'll put my digits up here, which I guess we can't call them digits anymore. X.com at Brian Overby. OptionsPlay is the website for that's sponsoring this event, just overall, and OptionsPlaybook.com is my book and my website. You can buy the book there if you'd like. Thanks for coming, everyone.